Hello and welcome to another episode of Tell Me More, a hospitality data podcast. I'm Stephanie Ricca, as always, here with STR's Isaac Collazo and co-stars Jan Freitag. Hi, guys.
Good morning, Steph.
Good morning.
Oh, boy, we are coming in hot, starting peppy. I love it.
Caffeinated.
Very
And ready to
caffeinated.
go.
I think I had a little bit too much coffee this morning, so just FYI, I may be a little bit more exciting than normal.
Well, this will be fun, but first let me recap major headlines since last we spoke. Maybe not so fun, I don't know. We got through first quarter earnings season without a whole lot of whiplash since any effects from consumer confidence, tariffs, inflation hadn't quite been felt yet. But the month has been a bit of a roller coaster, right? Stocks, May consumer sentiment index reading was way down. But we've seen some highlights, right? We've seen some big ticket hotel sales. This week, we're recording on May 22. So earlier this week, Ryman announced that they bought the JW Marriott Phoenix Desert Ridge for $865 million. Ding, ding, ding. And we are approaching the Memorial Day long weekend here in the U.S. with record travel expected. So you take the good, you take the bad, right, guys?
And Marriott launched a new brand because
Marriott
it's a Wednesday.
launched. We buried the lead. We forgot a new brand. So I don't know the number. 31, 28, 33. We'll
Sure.
figure it out. Something up there, another new brand. Lots to talk about. Let us start the episode the way we always do with a running leap through the April performance data from Isaac. Isaac, take it away.
Yeah, can I say that maybe I'm on a watermelon sugar high already? It's kind of, could be. It's Memorial Day weekend. All right, I know. I'm a little ahead of myself. It's not the Memorial Day weekend just yet, but I'm already there. All right. So first of all, with the April data, I must say that I was totally wrong again. So, for those of you that come into my office, and Jan's laughing at me, when you come into my office, you can actually see on the board the calculations I make, and I try to, predict how the month will be. We have a real forecasting process, but then as the weeks are going along, I'm actually doing even more work trying to understand. I thought April would be down by 1.6% in RevPAR, but no, it wasn't. It was up, or not up, but it was flat at minus 0.1. And that brought our year-to-date to 1.6%. I think some of the highlights that I started looking at the data, so there's lots of little pieces, and we'll go into it why I was wrong, because I did miss a piece. The ADR came in at 1.8%. What was interesting about that, it's the highest since January, but, I always say a but it's still below the rate of inflation. And in fact, ADR has been below CPI in 9 of the past 12 months. But overall, year-to-date, ADR is up 1.9%. What drove the decline in RevPAR, obviously, then was demand, sold rooms. It fell 1.2%. Year-to-date, it's at 0.4%. This is the first drop in room demand since September, and of course, it was due to the Easter shift, so that was not a surprise. What was a surprise is I go back to what I said when we started this portion, is that I really thought the Easter week would be down much more than it did. And so that's why my forecast completely was blown away. I was actually very surprised that decline, that Easter demand decline, wasn't even more severe. It was severe, but not as much as I thought it would be. Overall, demand for the month was down 1.3 million room nights. But I think, again, another piece I keep looking at, a year ago, we're also focused on sentiment. Everything is going south. But a year ago, RevPAR, year-to-date RevPAR was only up 0.5%. Again, right now it's up 1.6%, right?
Was that a personal jab at me, Isaac, since I'm always sharing
Actually, it's
the wah headlines?
Remember, no, it's Jan, my pessimistic friend, who keeps telling me the world is ending. And I go, if the world is ending, I kind of feel good. I feel fine.
I feel fine, right?
It's the end of the world as we know it.
Yes, exactly. And lots of musical references this morning. You missed some, folks. You weren't at the beginning of this, but we were actually singing earlier. Going back to the real data, ADR, year-to-date ADR a year ago was 1.8. So it's up, slightly better than it was a year ago. And demand a year ago was actually year-to-date demand as of April 2024 was down 0.7. And recall, right now we're up 0.4. So while there's lots of headlines, you could actually say this year is actually better than last year. I know no one wants to hear that per se, but that's the data is the data, and that's what we're seeing. And again, March and April were very weird because of the shift in Easter, and a lot of that, again, we know some of the growth came in the first 2 months of the year. Looking at market type, this was also very surprising. This is how I truly missed my forecast. Top 25 RevPAR for the month of April was up 2.1%. Listen again, up 2.1%. I didn't expect that. ADR was up 3.5%. So the RevPAR gain was essentially on ADR because sold rooms were down about 1%. What really pushed that was one market, a market we haven't talked much about, but we talked about a lot last year. It was San Francisco. San Francisco RevPAR for the month of April was up 37.4%. That one market accounted for 0.9 percentage points of the top 25's RevPAR gain in April. Isn't that crazy? And again, the big conferences, we know what was going on. It was all conference related. I thought it was also interesting to see that Tampa, Miami, Los Angeles, New York, and Chicago all had RevPAR gains in the month of April of greater than 6%. In total, 11 of the 25 had positive RevPAR this month. Now, on the other side, New Orleans, Nashville, Philadelphia, Washington, D.C., and Dallas saw RevPAR decline by more than 5%. And Dallas is a special reason because we're going to talk about that a little bit, but there's the eclipse markets. And last year we had a solar eclipse, so Dallas was part of that. So that was their impact. And they also have their conference center. The convention center is down. So there's two things that happened for April. Year to date for the top 25, RevPAR is up 1.8%. So basically a little better than the national RevPAR. Then looking at the other markets outside the top 25, RevPAR for the month of April was down 1.9%. ADR was only up 0.3%, and the rest of it, again, the decline was in the sold room side, the demand side, which was down minus 1.9%. But we mentioned the eclipse markets. We had identified 16 last year, and those 16 markets year over year were down 12.6%. So if you take those 16 markets out, then everything else remaining outside the top 25 only saw RevPAR fall minus 0.5. So again, not as dramatic as the first number would suggest. And ADR there was positive at 1.3%. When I took even a deeper dive looking at those other markets outside the top 25, RevPAR had fallen the most in the Northeast, which was down 4.1%, and it was on demand, which was down nearly 3%. And then on the flip side, the southern parts of the U.S. actually saw RevPAR grow 1% in these other markets, excluding the top 25, and ADR was up 2.4%. Overall, for these other markets, excluding the eclipse markets, RevPAR is up 1.2%. So again, the eclipse markets really, really had an impact. We forget about this. We always, we remember it in the year that we're in, but then we forget about it the year after. So
I had completely forgotten about it.
Yeah, so that was a big driver. Again, a much more better month than I expected. And again, a lot of that coming from the top 25, which I just completely missed when I was doing all my week by week calculations of how I thought the month would end. Quickly on global, not much on global, but globals continue to see very good RevPAR growth at 5.2%. It's on ADR, which is up 4.8%. RevPAR was the highest gain for the global market, and this excludes the US, since January. Year-to-date RevPAR is up 4.6% on ADR at 4.5%. A year ago, the global April RevPAR was up, April year-to-date was up 4.1%. And that was on sold rooms. This year it's on ADR. Last year it was on occupancy. Some call-outs: Japan, Middle East, Africa, India, Mexico. RevPAR there grew by 18% or more, led by Japan, which was up 23% on ADR. Latin America had a good month as well, up 15%. The Caribbean was up 7%. And then in Europe, key countries ranged from Italy, which was flat at 0.2%, to Spain, which was up 4.9%. And then finally to Canada, our good neighbors to the north, they were flat at 0.2% for the month. And then China was down minus 3.2%. well, again, we talked about it last time. Demand is up in China, but it's a supply issue. Supply is increasing at about almost 4%. So it's negating that growth in demand. And so that's a quick view.
Well, this is the time of year where we'll start to look at those international numbers, especially as we think about outbound U.S. summer travel.
And I should add, since you said outbound was again up in April, and it's up year to date. Mm-hmm. So I was really surprised by that again, because I thought it would come down. And then, of course, inbound is down year to date. But just as a reminder, if you look at the data, April year to date, inbound, it's still higher than it was in 23. It's just lower than it was in 24 by about 500,000. Yeah, I think it's about 500,000. I don't remember the exact number, but it's down. There's no doubt it's down, but again, it wasn't as dramatic as we expected it to be, because it did rebound in April a bit.
Jan, what do you think about this? Surprised by that top 25 performance?
Yeah, a little bit. I just want to call out Isaac's brain power, because he talked me off the ledge. The most important slide that he created in the last probably 90 days, maybe 60 days, is the impact of the school calendar shift. And I was really disappointed in March that the positive Easter rebound didn't really happen. And I was quite surprised how April turned out. But then he shows the percent of students K through 12 on vacation, and that had elongated. We talked about it last time a little bit. I use that chart all the time to explain a little bit about the performance of the last 60 days. And I think it makes a lot of people feel a lot better about the underlying performance, because we can explain away a lot of the demand shift by how students' vacation and spring break shifted. And the other part, just to call out our friend Jamie Lane from AirDNA, he had this really fascinating chart a year ago about the 110,000 short-term rentals in the path of the solar eclipse. I think that went viral globally. I also used that in the presentation just to show, hey, he tracked short-term rentals, we track hotels, but basically there were some outlying areas that saw this huge influx of demand, because if you remember, the eclipse happened on a Monday, so a lot of people took a long weekend. And those 2 nights or maybe even 3 nights of demand, that obviously didn't happen this year. So all of this is just very, very helpful. I do want to call out, however, you were so happy with the ADR percent change. And yes, that is on the top line, obviously a good number. But if I go down the classes, right? Luxury up, this is for just April, luxury up 5, upper upscale up 2. Okay, that's good, that's healthy. But then from upscale down, upscale minus 0.2, upper midscale minus 0.3, midscale minus 1.1, economy minus 0.3. Point is flat to down ADR. Yes, you can explain a lot of that with the eclipse markets probably, but this whole idea of pricing power or lack of pricing power, we always hope that we hit CPI. For those lower segments, for those limited service, select service type classes, I hope we get to 1%, not even CPI. So that's what I'm watching as the summer progresses.
Can I just be happy for a minute, please? For you, first you tell me I haven't done anything good for the last 90 days except one chart, and now you're telling me I'm not looking at the ADR correctly. Can I just be happy? I want to be happy.
That chart was amazing.
Ride high on the success of the chart. So who's going to say the B word after that? Bifurcation? Still a thing?
Yes.
Well, you talked about, yeah. We haven't said,
of course.
We haven't said that in a while, probably because it's been.
Yeah, I mean, it's here to
part
stay.
Of it. Yeah.
You mentioned you mentioned the earnings calls for the brands. I mean, I looked at the earnings calls for the airlines, and it's basically the front of the bus versus the back of the bus. Very, very different outlooks.
And the private planes that Jan flies is very different.
you got to stay saying that. The international inbound number is down. I was getting pinged by Adam Sachs from Tourism Economics this morning just to reiterate that they're proposing international inbound down 9% this year. So year to date, it's down 2.5%, I think. Yeah. So we have not seen the last of that yet.
But just remember, again, it just represents, we believe, between 4 and 7% of all room nights in the United States. Obviously, certain other markets may have more exposure, But from a total national perspective, it's about 4 to 7. And we estimated it for some data that we released a few weeks ago at about 5%. So.
So now it is time for our first deep dive topic of the month. And Jan is going to start this for us. He's got some interesting pipeline data to share, which we will show you some of the charts that he's going to refer to in the story accompanying this podcast. But Jan, tell us what we're looking at.
Yeah, for the last 38 months or so, whenever I've presented data, I've showed a pipeline slide that shows the number of rooms in construction, and I said, nothing to see here. The number of rooms in construction has been between 150 and 160,000 rooms in construction, literally for over 3 years. And it was kind of a boring chart. The point was, some hotels are opening, some hotels are breaking ground, but there's not this huge acceleration or deceleration. We're just sort of slow and steady. The good news is, as an industry, right, we're not overbuilding, right? Last year, room supply growth was, I think, 0.6%. This year to date, it's 0.7%. So all of these numbers are pretty manageable. But over the last 4 months, the number of rooms in construction has actually declined. And I don't want to say sharply, but what we saw in April, it was 141,000 rooms. So at the year end last year, 2024, we had 150,000 rooms, 154,000 rooms in construction. Now it's 13,000 rooms less. It's 141,000. And the trajectory seems to be pointing in one direction, right? So interest rates matter. But over the last 3 years, throughout the gyrations of what higher construction costs do, owners, developers seem to have found a way to get financing and get conviction and saying, yep, we're going to break ground. It seems to me that now suddenly, yes, hotels open, but there are not as many breaking ground. Now, we're implying real-time reactions to the tariffs. That's probably not quite true, but I think the higher for longer interest rate environment added to the uncertainty with the tariffs have probably given some developers pause and said, you know what, I don't know how much my beds from Indonesia or my TVs from China actually cost. So let me just sit for 6 months and see if those tariffs are, maybe they're just going to disappear, or maybe they're going to be 20%, who knows? Right? Maybe I'm just going to sit on my hands for a little while. And what we're seeing, therefore, is the number of rooms in construction is decelerating, which is not something that we had seen. When I look at it by chain scale, it's really all across the board. So at the beginning of the year, we had 8,000 luxury rooms in construction. Now it's 6,000. For upscale, it was 37,000 rooms in construction. Now it's 34,000. Mid-scale, it was 15,000. Now it's 13,000. So all the classes are decelerating, just implying that rooms are opening and but very few people are breaking ground. That hasn't impacted the top 5 markets in the pipeline yet. So if you add what's in final planning and in construction together, not a big surprise here, I don't think, to anybody who's listening to us for a while. Nashville, Phoenix, Dallas, Denver, Miami, those markets are the top of the list for developer interest. And, as Isaac said, the South, is very, very strong, was very strong year to date. And that's where a lot of developers have focused for the last couple of years. And of course, always we're going to call out New York City, the strongest in construction pipeline, very, very few rooms in final planning just because of the zoning changes. So I just wanted to call that out as, interesting. The pipeline is decelerating, and this all comes on the heels of this tariff conversation. I was at the Urban Land Institute ULI Hotel Development Council last week in Denver, and one of the conversations I thought was really interesting, that a couple of people mentioned that subcontractors are not as busy right now as they used to be, and so that they're actually pretty aggressive in their pricing. The problem is that with tariffs, things get more expensive. So it's sort of like what the subcontractors giveth, the tariffs taketh away. And so you still end up with probably a higher bill than you wanted, than you underwrote, and you may not immediately break ground. So we're going to watch that as the year progresses. But again, we're not overbuilding.
what implication does this have, or how do conversions fit into the overall conversation then? Because we've heard brands for the last couple quarters say, oh, conversions are ramping up, conversions are ramping up. If hotels are still opening and maybe not new builds, do we see that conversion data showing up in the data? Isaac, I know you've looked at conversion data for the last couple quarters.
Yeah, no, that's a great question, and you caught me a little bit off guard because I wasn't ready for. I was going to talk about pipeline, but I'll talk about conversions, and luckily.
And I absolutely want you to talk about pipeline too, but I think there is pipeline, there are conversions.
Yeah, since we started with conversions. What's really interesting, I looked at the first quarter conversions, so that's our latest data, and conversions versus a year ago are down. And they've never hit the peak that we thought they were going to hit. We looked at a 20-year average, and they're still pretty far down, right? Not far down, I shouldn't say that now, but they're down versus last year. So that was surprising to me. And again, a conversion in my how I define a conversion, it's the brand change. So it could be a brand within a parent company, but it is one brand to another, or from a branded to independent, and vice versa, independent to branded. What I thought is really interesting, looking at the slide and the data that I just worked on, I looked at, I categorized, basically, I just told you how I'm categorizing brand changes or affiliation changes. And so branded to independent is down versus a year ago. A year ago, we probably had close to 160,000 rooms, 160 hotels convert from branded to independent. Now it's closer to 140. And then even a brand to a different parent is down. Only 100 hotels have converted this year versus close to 140 last year. And then independent to brand, that's the only thing that's up, but we're not talking like up by a great amount. We're going, last year, there were about 80 hotels at this time. And I should have said this is first quarter data. And right now it's getting like 90 hotels. So not a heck of a lot of movement there. But there's some movement. We're still working through this data. In fact, literally, I just finished that over this past few days. But again, I'm not seeing much in terms of conversion activity like ramping up at this point. And then the only thing I'm going to add about pipeline, since Jan mentioned it, most of the pipeline growth is in the South, and it's outside the top 25. And the most amazing thing, not an amazing thing, but the thing that's most striking to me on that data is in the South, the other markets outside the top 25, there's a heck of a lot of rooms in the the final planning stage. In construction, it's about 50,000 rooms, but you have in total, there's about 150,000 rooms in both in construction and final planning in the South outside of the top 25. And then within the top 25, again, the most activity is in the South, and then it goes down to the West, Midwest. The least activity is the top 25 Midwest and the top 25 Northeast in terms of pipeline.
Yeah, for the total US, we've seen the planning number increase just in the last 4 months from 350,000 roughly to over 360,000 roughly. And the final planning number has also increased by 10,000 rooms. So we're clearly seeing this wait and see approach from developers. You mentioned the South, but it's certainly also visible across the United States. If I can just add real quickly before we get really angry calls and emails from investor relations people from the big multi-branded companies. Both things can be true. You can say, yes, our conversion numbers are up, and STR can say, well, the conversion numbers within the US are not showing a strong acceleration because the publicly traded parent companies are talking about global.
Yes.
Right?
Right.
In the US,
thank you for clarifying
70% of rooms are basically branded. Only 30 are not. Only 30% of the rooms are not branded. Globally, it's the other way around. There's a lot more greenfield opportunity to take an existing hotel and rebrand it and change the flag there or put a flag on it. And so just FYI, that's why we say what we say. Both of those things can be true. Yes. I was on a call yesterday with a major investment bank, and they're like, wait a minute, how does this square? I'm like, well, one is US, one is global.
And you're right. And the numbers I quoted were all U.S., right? So we've been just looking at the U.S. And again, it was only through first quarter. And yes, things can change dramatically from quarter to quarter.
Let me ask one final question on the pipeline topic. Any big hotels, big box hotels in the works that we should be keeping an eye on? I know we just saw the Gaylord Pacific open this week. It might just be soft opening. Now I don't remember. But any other bigs coming online?
I mean, CoStar News today wrote about the Chula Vista opening yesterday or 2 days ago. So that's a really big deal in San Diego. Obviously, the three Epic properties around the new Epic theme park in Orlando.
Yes, correct.
They just opened. That is partially why we think the Orlando data year to date has actually been a little bit softer, because people are postponing their trip because they want to then, when they want to go to those new theme parks. I heard this from somebody in the market. It was sort of an interesting anecdote. But he said, look, you used to say you go to Disney and then you do a day at Universal. But with these new Universal parks, it's like you go to Universal and then if you have a day, maybe you go to Disney. So this is just one person. I'm not slamming anybody here. But it's just an anecdote.
Boy, we're going to get all the calls.
Switch.
Yeah, thanks, Jan. That was really good, Jan. Thanks. I don't know Jan. I don't. He's not my friend.
Those Epics look really fun. Those are wild. All right. Well, that is a great unpacking and blurring lines explanation of conversions and openings and new builds. And now we are going to go into Isaac's topic of the month, in which he will unpack some of the demand highlights that he shared earlier. And let me just preface this, dear listener, by saying when Isaac told us that this is what he was going to talk about, he mentioned how he was leaping around with joy and excitement when he first started looking into this data. So brace yourselves.
This man is excited.
Exactly. It is, again, it's like being a kid in a candy store. Every once in a while, I have to pinch myself. Not only do I get to work with Jan and Stephanie, but we have this data. We have data everywhere. It's like a candy store. I mean, you have the red ones, you have the green ones, you have the blue ones. It's so much fun. And so today, as I was trying to think through, I literally came in this morning going, I'm not sure what my special topic's going to be. It was going to be on inbound and outbound. But then I started looking at something and I started looking at demand on a hotel level basis. And that they say, wait a minute, because again, April was so different from what I expected. And again, our data just got live at Friday. And I've been traveling. So this was the first day I could literally dig into the data. So when I first looked at that, we know the demand fell 1.2%. It's up year to date 0.4. Just to set the stage, again, first demand decline since September of last year. Well, what does that mean in real terms? It means it fell 1.3 million room nights. But then I wanted to unpack it and see, okay, how did that happen? So I put hotels into three categories: comparable. They had data in April of last year and data April of this year. Closed, they had data last year, but there's no data this year. They're closed or temporary closed. They're not doing anything. Or new hotels. So let's start going through the numbers. 1.3 million was the total that the industry lost. 2.2 million of that was from comparable hotels. But just hold that thought.
Wait. 1.3 million and 2.
We're going to do the math. Hold on.
Okay.
We have, remember, three categories: comp, closed, new. So totals 1.3, but comparable were down 2.2 million room nights. Closed hotels were down another million. So now 3.2 million were down. But new hotels offset that by 1.7 million room nights. And that's how you get to the 1.3. And there's some roundings, hopefully. But what I thought was more interesting for me is, okay, that's a lot of room nights. Oh my God, that sounds big. 1.3 million things, that's heavy. If you break it down by day, we lost, on average, 44,000 rooms per day in the month of April. Then if you take it down one layer further and say, on a hotel basis, about 62,000 hotels in the US that we considered comparable, an average hotel only lost 1.1 room night per day. So
I think that's
really
why
some of the things I keep hearing, I expect people to be freaking out at this point, right? Because the news has been pretty heavy. We've seen, and we have seen, but every time I'm speaking in front of multiple groups, no one's really freaking out. I've been speaking in front of operators, so you expect them to really be on edge. But again, that kind of explains that they're not seeing. Yeah, some hotels did see a lot more room night declines that were comparable, but others also saw gains in the month of April. So again, 1.1 makes it more palatable, going, hey, okay, it's a decline, but it wasn't serious. Then I took it even further. The top 25 markets on a percentage basis were down 1.1%. And the biggest decline I saw was in the South at 2.3%. And then within the South of the top 25, the largest declines were in economy and mid-scale. Economy lost 5.2% overall in April in terms of room nights, and mid-scale lost 3.3% in the South top 25. On the flip side, top 25 hotels in the Midwest actually saw a gain in room nights. They were up 0.6% year over year. But even within the Midwest, economy was still a sector that was down. They were down 10.7% in room nights in the Midwest top 25. Outside the top 25, all other markets, the room demand for comparable hotels was down 2.3%. It was led by the Midwest and Northeast, where demand was down 3.7 to 3.6%. And it was also in the Midwest, the largest decline was in upper mid-scale, which was 4.4% decline year over year. But in the Northeast, it was economy and mid-scale, which were down by more than 4% year over year. And just putting it together and looking at the comparable hotels, again, they lost 2.2 million room nights overall, as I said at the very beginning. 44% of that loss came from economy and mid-scale, and 35% of that loss came from upper mid-scale. So again, and I literally just started this work. So this will be an article and we'll get deeper and we'll find more fact. But I thought it was really fascinating just to look at the data that way, going, why don't we just get down to hotel basis? Where is the loss coming from? And seeing the class side, that's what we've been talking about since last year. We do believe that lower to middle income individuals are being impacted more because of the rising cost of everything. And I think that continues to point to that yes, that's where you're seeing the weakness. And also there's also other factors, but that's one factor I think is important to keep reminding ourselves. So anything that does upset the economy, causes layoffs or increases prices could also further hurt lower end hotels, in my opinion.
Yeah. And with that demand piece, obviously then the next immediate relationship is to pricing. Right. So if you are on the lower end feeling a little bit of the pinch of having fewer guests, how are you going to react? Are you going to try, quote unquote, buy demand by offering deals and so forth?
So we will watch for more from this space, right? It's so interesting to look at how the data starts to reflect the trends and the headlines that we talk about even 12 months prior, Take some time, but then you see it.
But I also think it's so interesting, and that Isaac, I think the idea here is so helpful to say, look, on the total U.S. level, something is happening, and then there is the negative sentiment in the media, and then you drill down to the hotel, and you lose a hotel on average. But if you lose a hotel per month, it's like, okay, like you can live with that.
Yeah, room night. Oh yeah, or room night. Yeah, or a hotel.
That room night.
Sorry, room night.
Sorry.
Yeah, one, and it's again. I'm not saying that everyone. Some people saw more declines than others, and depends what part of the country you're in. But again, on average, it was 1.1 for these comparable hotels, and actually averaged about the same. Was just a little less when you did the entire U.S. without the breaks of comparable new or closed. And we will look at who closed. We'll do a lot more of the analysis. Again, the data is rich. That's why we love this place. And that's why I was so excited. I ran into Jan's office like a little kid going, this is so cool.
Hey, maybe we'll get some behind the scenes video footage of that kind of interplay for our special Kickstarter campaign.
Remember just Forrest Gump? That when he ran, that football player? That was Isaac.
Oh, great.
Everybody,
running through walls.
See, we don't even need video. We can picture that perfectly. Before we close up this episode with the fun part, You all know what I'm talking about. I have 3 quick programming notes to share with our listeners. First, keep an eye out for a special bonus episode of this podcast dropping in early June. We're going to record it at the NYU Hotel Investment Conference, and we will unpack the latest CoStar Tourism Economics forecast, which will drop at that event. So keep an eye out for that. Second, Tell Me More is going on the road. Well, one show only and not too far down the road, but we will be reprising our live version of the podcast at this year's Hotel Data Conference, which takes place August 6th through 8th at the Grand Hyatt Nashville. Register because it is selling fast and will sell out. Go to hoteldataconference.com. And finally, third note, we hope that as followers of this podcast, you're also active readers of Hotel News Now. Hotel News Now is in the process of changing its name to join the larger CoStar News family that we've been part of for 5 years now. You don't need to do anything, dear listeners. My team is all still here. We will still turn around if you shout to us, "Hey, Hotel News Now reporters," at an event, but you will begin to see CoStar News instead of the Hotel News Now branding. All good. We're just starting to get the word out. Let us go to the metaphor. You all know it. It's how we end every episode of this podcast, in which Isaac and Jan share a comparison, what they think about when they think about how the hotel industry is performing right this second. Isaac, start us off.
Yeah, this was a hard one. So I had two musical references. And again, so I started out with Joe, and that's spelled D-J-O, and he has a song called being basic. And I thought it's about the industry, just being basic, meeting the basics. But then, because I missed the forecast, it had to go back to Lady Gaga. And Lady Gaga has her hit song, Abracadabra. And that's what I think it was, like, abracadabra, it's not as bad as you think it is. And that's my song, and that's a great song, and you'll enjoy that when we put the playlist together. So both songs are actually good, but abracadabra is my metaphor for the industry right now. And it's reflective of me. And it's like, hey, things change. Abracadabra, things will change in a minute. So just keep doing what you're doing.
Hey, and if you caught it, we already made, I think, at least 2 other song references earlier in this episode. So we should add them all to our Spotify playlist, which is ongoing. We will link it in the story. Jan, what's your metaphor?
All right. Pull up a chair. This is going to take a second.
Ooh, exciting.
You have to explain your metaphor?
Yes. So
story time.
I'm from Germany. This is a soccer reference. Except we start way back in history at 9 AD, when the Romans were trying to march through Germany and were defeated decisively by a warlord who lived in the area that I live in, that I'm from, and his name was Arminius. And he sort of beat up 3 legions, and they built, the Germans in my area, built him a 175-foot statue out of steel, which is a German warlord with a sword up, and it's sort of, it's where you go sort of on a Sunday afternoon hike. So this Saturday at 1 o'clock Central, 2 o'clock Eastern on ESPN Plus, they're airing the German Soccer Cup final, and my team, which plays in the 3rd division, is facing some other team which plays in the 1st division. So Arminia Bielefeld, the team that I grew up with and love, has its biggest game ever. And just for reference, 3rd division teams never make it to the cup final. This is only the 3rd time in its history that it's happened. All of Germany is cheering on the underdog. The team is called Arminia, and Arminia is off this warlord, Arminius. And so we have high hopes that we will be the underdog, defeating the Romans, well, in this case, this 1st division team. And what the people in my hometown did is they made this statue a jersey. And we're going to link to the video in the show notes.
Yes, we will.
But it is an absolute sight to see. So how do we relate this to the hotel industry? Not really, just keep the faith.
Well,
underdogs prosper.
Underdog,
Exactly.
I was going to go. That's the connection, right? Never give up on this industry.
Exactly.
Never give up on Armenia. No, not Armenia. Arminius. No,
Armenia.
Armenia.
Yeah, Armenia, and Arminius is the warlord.
warlord.
But anyways, think of me, everybody, this Saturday.
Definitely.
Absolutely, we will. What a fun one. As always, thank you both for your insight. Thank you to our listeners. Find the latest global hotel industry news on hotelnewsnow.com. Yes, you can still use that website. Find this podcast wherever you like to listen. And keep an eye out for all of us at the NYU Hotel Investment Conference coming up in early June. Thanks, guys.
See you there.
See you, Steph.
Bye.
See you there.
Hi, I'm Davon Reed.
I'm Omari Head.
And I'm Chris Henry.
We're the hosts of the Next Gen and Lodging podcast on the Hotel News Now podcast network. It's a monthly show in which we interview a new generation of hoteliers to get their insights into a variety of disciplines and topics, from finance to food and beverage and hotel operations. Listen to us on Spotify, Google, Apple Podcasts, or wherever you get your podcasts.
This episode of Tell Me More, a Hospitality Data Podcast, was recorded on May 22, 2025 by me, Stephanie Ricca. The episode was edited by Rachel Daub. Find all hotel industry news at hotelnewsnow.com. Subscribe to this and all Hotel News Now podcasts wherever you like to listen. Just search for Hotel News Now. Thank you.